welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. One advice that you will perhaps often hear from financial planners is to keep insurance and investment absolutely separate. Now, there is good merit in this argument. A term insurance plan is perhaps very, very simple and easy to understand, easy to execute, and investment objectives can be met separately through instruments like mutual funds. But to be fair, the insurance industry also offers a wide plethora of products that offer you both a life cover as well as investment. So is there any merit in considering some of these policies? Are ULIPs worth taking a look at in the LTCG era? Well, these are some of the questions that we will answer on today's show. And joining me to do that is Raghavendra Nath of Ladder Up Investments and Rahul Parekh, who is the CEO of Bajaj Capital. Gentlemen, thank you so much for joining us. It's an interesting topic at hand that we have because it's a big, wide debate out there. And I thought we'll only be fair to our viewers if we also do a thorough SWOT analysis of some of the market-linked insurance products which are out there. So, Rahul, let me start with you. Some opening thoughts. This wide perception that investment-oriented insurance products are a bad play. Do you subscribe to this view? What would your opening remarks be?
I don't agree with the view that investment-oriented insurance products are bad. I think it depends upon the investor and the need of the investor. I think they are fantastic vehicles to invest for long term. And when I say long term, anything upwards of 10 years is what I would qualify as a right investment horizon for investing into a ULIP kind of product from insurance companies. So I believe that they can fulfill both the things, the protection part as well as investment part for longer periods of time. And generally, I think we would encourage young investors to kind of look at ULIP favorably after the charge structure has been modified by the regulator. Okay,
that's interesting. Mr. Nath, I think the timeline that Rahul also mentioned is important because he's saying if you can be in it for at least 10 years, what is your opening view?
Yeah, so I think what you were telling in the beginning, that perception has kind of gained ground that ULIPs are not good or traditional plans are not good and you need to basically separate term and investment. And there is some merit in that argument, there is no doubt about it, okay? But over the last 5-6 years, after the regulatory changes have been brought about, after the cost structures have been rationalized, some of these plans have become quite efficient. And so investor has to be discernible to figure out which plan to choose. And unless he's looking at something which is actually a hybrid, kind of investment, which is a mix of insurance as well as investment. But if he's looking at pure investments, that there are certain products with each insurance company which are as efficient today as a mutual fund.
Okay, fair enough. So I think it's important to then know how to pick the right instruments, and that's not always easy when it comes to the world of insurance. Let's start with the basics. When we are talking about market-oriented investment products, or insurance products rather, then the market can be of two types. We can talk about the capital markets or we can talk about the debt market. So Raghavendra, why don't you just quickly run us through some of the fixed income-oriented traditional policies. Of course, we're not spending too much time over there because we'll be spending more time looking at products which are linked to the equity market. But which are the fixed income market-linked insurance policies and the sort of returns that one can expect?
So, when it comes to fixed income, I think the traditional plans of insurance companies actually merit a good look actually, so whether you look at endowment plans or money back policies, and all the insurance companies have those products which have two features. One is assured return. So an investor is guaranteed a minimum return of 5-6% over the lifetime of the policy, as well as some guaranteed those additions and bonuses as they call, and they call it differently, different insurance companies. So those plans basically compare well when you compare with vis-a-vis a fixed income investment for an investor who's in a high tax bracket. So let's say if you are going for a fixed deposit at 8%, post-tax you are going to get something like 5.5%. And so if you are, let's say, looking at a traditional insurance policy, which is like an endowment plan, it is actually going to give you something similar, 5 to 6% kind of return, maybe a little more. Okay, so they compare quite well with, But when you look at, let's say, a ULIP, which is probably a fixed income, and there, because of the charge structures, you may not be at a very efficient stage,
Okay, all right. So we'll discuss ULIP separately. But Rahul, your take on, first of all, the traditional policies. Right now we're talking about instruments which are linked to the fixed income market. So the argument that maybe a 5 to 6% return is not too bad, do you subscribe to it? Because it also takes away the flexibility, right? All said and done, in a fixed deposit, at least I have instant liquidity.
I think I would agree with what Raghavendra mentioned, that there are good traditional plans which offer you anywhere between 5 to 6% post-tax returns, and for a person in a high income tax bracket, I think it makes immense sense, because let's not forget, India has a large savings market, and the savings market typically ends up investing into products like either deposits or maybe long-term products like PPF, etc. And there I think such products compare favorably. Also, I think it covers one more need, which is the insurance need, which helps you to kind of build asset on day one of your investing. So in that sense, I would say that large portion of savings market can be targeted through traditional products, because they compare favorably on a post-tax basis for people in the high tax bracket.
Okay, so before we take a break and we start talking ULIPs full throttle, I want our experts to also outline maybe a couple of examples, product examples on the traditional policy side, which you think merit some kind of a look at from an investor's or a policy buyer's point of view. Mr. Nath?
So on traditional, I have not, because that segment is a very wide segment. In fact, in each insurance company, that segment is the widest segment, because of the kind of structures that they have, the charge structures. But generally, I found that life insurance corporations plans, which are traditional, which are like they are they are quite efficient. There have been some policies which have given as high as 7 or 8% returns also to investors.
Okay.
So, but I would not have something very specific that this plan is efficient and this is not. Because most of them are in that range of 5 to 6%.
5 to 6%.
And as Rahul was saying, that it's basically depends on what kind of investor you are.
Absolutely, absolutely. It all begins there. Absolutely. Rahul, just your thoughts as well. I mean, it's a wide sort of a canvas, but if you are looking at traditional plans, whether it's an endowment policy, money back policy, maybe some names, product names as well, where the cost structure is low and the returns are fairly efficient?
Sure. So I think Raghavendra rightly pointed out, I think LIC policies are a good option. But if you were to look at in private sector, we would prefer Birla Secure Plus. We would prefer Excite Star Saver. We would prefer Tata Smart Income Plus. These are the traditional policies that we would recommend.
Okay, fair enough. We'll take a quick break on that note, gentlemen, but stay with us, because when we come back, we get the debate going on ULIPs. Should you be looking at equity market investments via your insurance policy? Now the tax is quite comparable, even favorable towards ULIPs. So then does it really deserve a look at? We'll be back in a moment. It's perhaps time that you start considering ULIPs as an investment vehicle, along with, of course, an insurance providing one as well. We're in conversation with Rahul Parekh of Bajaj Capital, as well as Raghavendra Nath of Ladder Up Investments. So, Mr. Nath, I know you've done some calculations for us. I mean, I gave you homework of sorts to do, because I think it's very important to understand the cost structure. Now, we are taking a 10-year period, because as both of you highlighted that to do a favorable analysis, let's look at a 10-year period, an investment amount of about 10 lakhs, which is going to be sort of split in terms of my premium that I'm paying for the insurance policy, and 10 lakhs as an investment in a mutual fund, and then look at a market return. And now you tell me which is a more efficient product, and basically where do I get better returns?
Yeah, so if you look at an insurance policy, it has some, the charges are split in 3 or 4 buckets versus, let's say, a mutual fund which has a one fund like, in the total expenses 2.5% or 2.6%, which is regulated by SEBI. So insurance policy will have a mortality charge, it will have a premium allocation charge, it will have a fund management charge. So some 3 or 4 charges are levied on the policy. Some of them are a percentage, and some of them are absolute amounts. So like premium allocation charge, I observed, is an absolute number every time. So the insurance company may charge 6,000 rupees or 7,000 rupees or 60 rupees per month or 70 rupees per month as those premium allocation charges, depending on the nature of investment that you're doing.
And that remains constant through the life of the policy?
Yeah, so typically till the time you are paying the premium.
Right.
So, so let's say in a single premium plan, that charge will be charged one time, you know. In case of let's say annual pay, it will be charged every year till the time you are paying. You know? And then there's a policy administration charge, the one that I was missing, which is charged annually, you know. So typically in a single pay, that policy admin charge is very less, you know, whereas in a multiple pay, an annual pay or a quarterly pay, that charge is higher. And that's the reason why initial years a policy is not very efficient, you know, because of the charges.
Multiple charges.
Yeah, multiple charges. But as the period elapses, then the only charge that you're paying is a you know, fund management charge.
And the mortality charges, also from what I understand, the mortality charges are much higher when you initially buy the policy, and then gradually do they reduce?
So it's very interesting in case of a ULIP, because in case of, let's say, a term plan, when you are paying a certain sum of premium, your risk cover is constant, you know. So let's say you get 1 crore or 50 lakhs or whatever is the sum. Here, insurance policy is giving the higher of the two, your fund value or the sum assured as the you know, risk cover.
Upon death.
Upon death. Okay, and therefore, as your fund value keeps increasing, the sum assured basically, or for which the premium has to be charged, keeps on reducing. You know? So initially it will be higher, and then it starts falling down. You know?
Rahul, your thoughts on some of these charges, and how do they stack up when we're looking at the very neat and tidy figure of 2.5%, 2.6%, which would be the total expense ratio for a mutual fund?
Sure. So there are 4 buckets, like Raghavendra mentioned. There is, you know, the policy admin charges. There is the premium allocation charges. There is the fund management charges, and then there is a mortality charge. Now, each of these 4 components, we need to put it in perspective. So the allocation charges typically for the regular premium kind of policies are higher upfront generally. They range between 0 to 6%, and then eventually they kind of keep on decreasing. Also, they can be offsetted by you know, guarantee loyalty additions. So I think that can take care of some of these allocation charges. Then there is this admin charges, which increases with every passing year to kind of, you know, maybe by 5% or so. Then there's mortality charges, and mortality charges you know, typically shoot up when one goes in, you know, 50 years and above. So generally, you know, ULIP may not be a right product for anybody above 45 years, because the mortality charges are very high, and they take a significant sum out of your investment. And you know, all of this, when you put together, that's why in the initial years you would find that, you know, ULIP will underperform compared to mutual funds up to almost 10 years, and we did a bit of maths on this. But after 10 years, because the only thing which is left out is fund management charges, which is significantly better than the mutual funds, I think they tend to kind of, you know, outperform mutual funds on a similar return basis. One another thing that I would want to highlight is it's about also the fund performance, and we had a basket of almost 74 ULIPs with around 160 odd mutual funds, and we figured out that at least in historic terms, a lot of mutual funds have outperformed ULIPs by a significant margin on a CAGR basis, which ranges from 100 basis points to as high as 400 basis points over various time periods. And I'm talking about 3 years, 5 years, 7 years kind of time period. So I think there's no right or wrong answer in terms of choosing this, but I would advise that it should be a combination of the charges that you're paying, as well as the kind of fund performance that the ULIP showcases when you're comparing vis-a-vis an equity mutual fund, because that's where the real picture will pan out. And generally speaking, mortality charges being high after 45, one should avoid ULIP and only stick to mutual fund for investment purposes.
That's a very, very important point that you've highlighted, absolutely, Rahul, because with such high mortality charges, I guess it just would not make sense for someone who's above 45, 50 to be looking at a ULIP product. Then you'd perhaps just be better off splitting your investment and your protection needs into 2 different types of instruments. But just to put the numbers in perspective, Raghavendra, I know you've done this model, so just tell us. So I think what we're assuming is that the investment is 10 lakhs. I think the age is 40. 40 is the age that you've taken, because that's still a good enough number, good enough age to consider a ULIP. And you're assuming market returns of about 12%.
12%. So if you invested, let's say, 10 lakh rupees in ULIP versus a mutual fund, and you invested that money for 10 years, and let's say both of them generated the same returns of 12%.
You know, before you actually carry on, let me ask you one more question. In ULIPs, can I be certain that almost the entire amount that I'm putting in, the 10 lakhs, is going to go towards investment? Because the entire doesn't, right? So then how do I account for that?
Yeah, so that premium allocation charge, which is that 3%, 4% in case of a single pay, is what gets deducted. Everything else is going in investments.
Okay.
And so to that extent, you are starting with 3% less. In case of mutual fund, you're starting 3% more. So let's say over a 10-year horizon, ULIP basically, we looked at two ULIPs. We looked at an ICICI Pru Elite Wealth, and we looked at Birla Sun Life Aspire. And in both the cases, the charges were around similar, you know. So the overall charge worked out to something like 1.8, 1.9% versus a mutual fund. Let's say you are going for a regular plan with the help of a distributor and not the direct plan.
Yeah.
So there the charge was around 2.5, 2.6% depending on the size of the fund, you know. And that 0.7% differential basically amounted to a difference of something like, you know, almost like 3 lakh rupees.
In a 10-year period?
On a 10-year period. You know, so 10 lakhs would have become 26 lakhs in ULIP, and 10 lakh became 24.5 lakhs, 24.8 lakhs in mutual fund. But now that difference was not much. That was only 1.5 lakh rupees difference. But because of the tax element now 10%, that has got enhanced. So
sure, I mean, if you're looking at pure mathematics, pure arithmetic, then the numbers might tell you that ULIPs will actually outperform mutual funds over a 10-year period. But there are lots of soft factors, including the performance, the fund manager, and of course the age of the investor. We continue this conversation after a break. The important points you need to ask yourself before you decide to opt for a ULIP. Welcome back. You're watching Money, 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 and we've been in the midst of a very interesting debate. ULIPs or mutual funds, which is a better product if you're looking at long-term investment? And of course, ULIPs also offering you the additional cover. Rahul, I think you've raised some very, very important points. So let's now boil this down to simple questions for our viewers. What are the key things as a policy buyer I must ask my broker or distributor before buying a ULIP?
Sure. So I think two things that definitely you should ask for is what has been the fund performance of the ULIP in the past, and what are the kind of charges that are being levied if your sole purpose why you're investing that is for the long-term investment purposes. One additional point I would just want to make over here quickly, in addition to what Raghavendra mentioned, is I think it also depends upon your the kind of investor you are. So if you're a retail investor, typically for lower ticket sizes in the ULIPs, the premium allocation charges are higher, and which means that the return comparison that Raghavendra just spoke about over 10 years may significantly vary. Also, we need to remember that in the equity mutual funds there is a long-term capital gains, and the capital gains is kind of charged at 10% plus cess only above 1 lakh. So one also needs to differentiate between a retail and high ticket investor, because again the calculations will change over here. But the two questions which are paramount is what has been the past track record and fund performance, and what are the charges in the ULIP. If
you could just sort of recommend some of the products, some of the names that you think are fairly decent out there, and is there a lot of variance in these premium allocation charges? Because then that's a red flag, and we as policy buyers need to be very aware and constantly ask about the nature of these charges. Is it not very uniform?
Yeah, so let's say for example one of the well-performing, Raghavendra did mention about some of the well-performing ULIPs. I would add to that, let's say Bajaj Future Gain. Now again over there above 2 lakh there is zero allocation charges, but below 2 lakh of premium amount there are allocation charges, and again it's slab wise. So as I said that the lower the ticket size, the higher will be the allocation charges.
Oh, absolutely. So you need to know how much of that investment you're making is being taken away by the premium allocation charge. Mr. Nath, so final thoughts. I mean, all things put together, the good, the bad, and the ugly of ULIPs. Your advice and some of the products that you've seen and find are fairly decent to look at.
The biggest advantage that a mutual fund today offers is flexibility of withdrawal, that liquidity, and flexibility of choice. If a fund manager is not doing well, he can switch over to somebody
Change out
else.
at any time.
And
Yeah.
these are the two things where which you are compromising.
Sure.
So the first one, which is liquidity, is not so important because in every person's portfolio there will be some investment which he can definitely kind of sacrifice the liquidity for long term, which is typically his retirement money. And in future, because the new categorization of mutual funds have come about, the outperformance that the mutual funds have had in the past may come down a little bit. So now the ULIPs will have a little more level playing field when it comes to fund performance versus mutual funds.
So any examples that you'd like to leave us with?
So ICICI and Birla is the two that I looked at. So Birla Aspire and ICICI Elite Wealth were turned out to be quite efficient products.
Okay.
And as Rahul mentioned, Bajaj also has one of them. So every insurance company will have one product actually.
Well, gentlemen, thank you so much time to take us through some of the finer nuances when it comes to investing in market-linked insurance products. It's a slightly confusing world, so therefore one does need to go out there with caution, ask the right questions, and then go ahead and purchase the policy document. Thank you very much for being with us. Of course, our viewers, your feedback, queries, questions, welcome as always. We'll see you again next week.